Welcome everyone, and thank you for joining today's session titled Introducing Option CFDs. I'm really glad you're here today because the aim of this webinar is to build a clear, practical foundation for understanding options, one step at a time. If you already trade CFDs on shares, indices, forex or commodities, you may find that option CFDs add an extra layer of flexibility to the way that you approach the markets. Now, they're not a replacement for the tools you already use, they're an extension of them. Option CFDs can give you more ways to express a market view, manage uncertainty, and structure your risk. Now, over the next 20 minutes, we're going to slow things down and unpack the essentials clearly and calmly. Here's what we'll cover. What options are, including the basic idea behind calls and puts explained in everyday language. Discuss how option CFDs work on the Plus500 platform, including how they differ from both standard CFDs and traditional options. Look at the key forces that impact an option's price, such as the underlying market, volatility and time, and then run through why traders use option CFDs. And finally, we'll cover some risk management essentials, the key principles every trader should understand before trading option CFDs. No complicated formulas, just the key concepts to help you feel more confident exploring this part of the platform. By the end of this session, whether you're completely new to options or simply looking to expand your trading toolkit in a structured, informed way, the aim is that you walk away with a solid educational foundation that you can build on. Now, before we dive in, just a very quick couple of housekeeping notes. Today's presentation will run for around 20 minutes. We'll finish with a Q&A, so feel free to drop your questions into the Zoom chat or the Q&A box at any time. And please note that trading CFDs carries risk, and everything we cover today is purely for educational purposes. It's not financial advice. All right, let's get started. Now, before we look at how option CFDs work on the Plus500 platform, it helps to understand the basics of traditional options. That's because the option CFDs that you have available to you are priced from these traditional options. They move in a similar way to real option premiums, and the same forces such as volatility and time decay also affect the price of option CFDs. Ultimately, knowing these basics makes it much easier to understand why an option CFD moves the way it does. So let's quickly cover the core ideas behind traditional options. Now, traditional options are derivative contracts, which means their value comes from or is derived from another asset, like a stock, an index, a commodity, or a currency. The key idea is this: an option gives you the right, but not the obligation, to buy or sell an underlying asset, such as the S&P 500, at a predetermined fixed price, which is known as the strike price, on or before a specific date, which is called the expiry. Now, there are only two main types of options that we need to focus on. These are the call option, which is a contract giving a trader the right, but not the obligation, to buy an asset at a fixed price or strike price before the option expires. And these are typically used when there is an expectation that the underlying asset will rise. And the next one is a put option. And this is a contract that gives the trader the right, but not the obligation, to sell an asset at a fixed price before the option expires. These are typically used when there is an expectation that the underlying asset will fall. Once you understand calls and puts, everything else in the options world builds from these two simple building blocks. Now, when you have a traditional option, you pay a premium, essentially a fee for having the right or the option to choose what you may want to do in the future. This term is important because option CFDs on the Plus500 platform move based on changes in that premium, not the underlying asset itself. This distinction allows you to trade option CFDs in a similar way to standard CFDs. Let's look at the February gold option CFD as an example and run through the basics we have covered so far. Currently for gold, like the S&P 500 and NASDAQ 100, you have access to weekly and monthly contracts. Plus500 are adding to these weekly products offerings throughout the first half of 2026, so watch out for further additions to popular markets that you may trade. You can access options by scrolling down the list on the left-hand side of the screen. For example, I am accessing the monthly gold contract. What you see on screen is known as the options chain or options ladder. You have prices of calls that you can buy or sell on the left and prices of puts on the right. Down the middle of the screen, you have the various strike prices for gold that are available to trade. Helpfully, highlighted in orange going across the screen, you have the current market price of gold. This is important as this lets you know how close the strike price is to where the market is trading right now, which will directly affect the CFD price that you see. Calls with a strike below the current market price of gold will be more expensive than those with a strike above the current market price. And the opposite is true for puts on the right-hand side of the screen. When I click on the trade button, it brings up a tab with the details of the option CFD I have chosen to trade at the top of the screen. Here I've clicked on a call with a strike price of 4,590, and it's the February contract. If I want to see the exact expiry time and date of this option, I can click on the info tab, scroll down to the bottom of the screen, and it tells me this contract's expiry is the 25th of January 2026. The time shown reflects the local time in your location. So for me, that is 2300 GMT or UK time. If I move back to the trade tab, I can choose the number of option contracts I want to trade, depending on my plan, capital allocation and position sizing requirements. I can also move on and set my stop loss and take profit orders in advance, depending on my individual risk management considerations. Then, when I'm happy that everything is correct, I can click on the trade button, which in this example is to buy the 4,590 gold call. Now, as I said earlier, the option CFD prices that you see on your Plus500 platform are based on the premium of the traditional call or put option. That option's premium doesn't move randomly. It's driven by three major forces. Once you understand these, options behavior becomes easier to interpret. The first and most obvious driver of an options premium is the price of the underlying asset itself, whether that's a stock, an index, a commodity, or a currency. As the underlying moves, the option premium reacts. Sometimes this happens slowly, sometimes it's explosive, all depending on how close the market is to the strike price. Remember, the strike price is the preset price on which the option or option CFD is based. As a rule, when the underlying price moves towards or through the strike price, the option generally becomes more valuable and the premium increases. So a call option usually gains value as the market rises, while a put option gains value as the market falls. When the underlying price moves away from the strike price, the option usually loses value and the premium falls. So a call option will usually lose value as the market drops, while a put option will lose value as the market rises. The underlying price is the engine that drives the option's value. Every tick in the underlying creates a ripple effect in the option premium. And this is why traders often watch the underlying chart first, because the option's behavior is ultimately anchored to that price. Next, volatility. And this is one of the most powerful and misunderstood forces behind option pricing. It measures how much the underlying asset tends to move, and the more it moves, the more valuable options generally become. Why? Because options thrive on movement. As a rule, higher volatility equals higher option premium prices. This is because the market is moving more, meaning there's a greater chance the option reaches a profitable level before expiry. In this environment, both calls and puts can become both more expensive. As an example, before major events like an earnings announcement or new iPhone release from Apple, volatility often spikes. Even if the share price hasn't moved yet, option premiums rise because traders expect a big move. Conversely, lower volatility equals lower premium prices, as when volatility falls, the market is calm and there is less chance of a big move, and in this environment, options can become cheaper. So, during quiet range-bound periods, option premiums can shrink because the probability of a meaningful price swing in the underlying asset is lower. This matters for option traders because option CFDs track the premium of the real option and not the underlying asset. A rise in volatility can push option prices higher, while a drop in volatility can push them lower, even if the underlying chart looks completely flat. This is one of the biggest differences between option CFDs and standard CFDs, and one of the most important concepts for traders to understand. This is why traders watch volatility just as closely as price, sometimes even more closely. Then finally, time decay. And this is one of the most important and often surprising forces behind option pricing. It describes the fact that options lose value as the closer they get to expiry, simply because there is less time left for the market to move in your favor. Expiry refers to the exact date and time when the option contract ends. And I showed you how to find this on the Plus500 platform using that info tab earlier in the presentation. It is important to note, even if the underlying price doesn't move at all, the option can still lose value day by day. Time decay accelerates as expiry approaches. It's not constant. It speeds up dramatically as the option gets closer to expiry. As a rule, the further an option is from expiry, the slower the impact on option premium, while the closer you are to expiry, the bigger the impact on that premium. This is why short-dated options can collapse in value very quickly. Time decay is the only force that is guaranteed. It never stops, it never reverses, and never pauses. And for option CFD traders, this means you can be right about direction and the underlying can move your way. But if it moves too slowly, time decay can still reduce your profit or turn a winning idea into a losing trade. Understanding time decay can assist traders to choose the right expiry, the right strike, the right timing, and the right expectations for how quickly the market needs to move. Now, let's talk a little bit more about the difference between traditional options and option CFDs, because this distinction is crucial. Traditional options are exercisable contracts. If you own a traditional option, you have the right, but not the obligation, to buy or sell the underlying asset at the strike price before expiry. You can choose to exercise that right or simply let the option expire. This exercise feature is a core part of how traditional options work. Option CFDs on the Plus500 platform work differently. An option CFD's price is based on the premium of a traditional option, not the underlying itself. Here are the core features that you need to know. There is no right to exercise. You cannot buy or sell the underlying asset through an option CFD. There is no ownership. You don't own the option contract. You're only trading its price movement. Your profit or loss comes from changes in the option's premium, not the underlying asset. And leverage applies. Just like any CFD product, leverage is built in. And finally, you can go long or you can go short. You can take a position based on whether you expect the option premium to rise or to fall based on the factors that I identified earlier. Because of this, option CFDs strip away much of the complexity that comes with traditional options. You get exposure to option style behavior, strike sensitivity, volatility, time decay, without needing to manage the full traditional options framework. Now that we understand what options and option CFDs are, let's talk about how traders actually use them. When we're dealing with option CFDs, the approach becomes much simpler than with traditional options. Because you're not managing exercise rights or ownership, you're simply trading the premium of the option. It means your strategies revolve around two things: directional views, bullish or bearish, and volatility expectations, high or low movement. For today, we're going to focus just on expressing directional views. So let's look at bullish strategies. If you expect the underlying asset to rise, a common approach is to buy a call option CFD. The goal is for the call premium to increase, which can happen when the underlying market rises, the move happens quickly, and volatility stays elevated or increases. Because option CFDs track the premium of the real option, any combination of these forces can push the price higher. So when might traders use call options CFDs? Well, let's run through some practical examples where traders may consider using these call option CFDs. Number one, trading positive economic data, where they may anticipate an upward move in indices or currencies. Expecting supportive central bank decisions. When a central bank, such as the Federal Reserve, is expected to cut interest rates, traders often anticipate bullish reactions in equity indices, rate-sensitive sectors like technology or growth stocks. Using a call option CFD can help capture that potential upside without needing to buy the underlying asset. Next, number three, anticipating stronger than expected company earnings. If traders believe results will beat expectations, they may buy call option CFDs to benefit from a potential price jump, elevated volatility, a surge in the options premium. And then finally, number four, trading a technical breakout to the upside. If an asset is breaking above resistance or is forming a bullish pattern, traders may use call option CFDs as a tactical way to participate in breakouts without the full exposure of buying the underlying. Number two, the next one, to consider is bearish strategies. If you expect the underlying asset to fall, traders often turn to put option CFDs. Just like calls in a bullish scenario, puts give you a simple way to benefit from downward price movement, but through the option premium, not the underlying asset itself. The goal in this scenario is for the put premium to increase, which can happen when the underlying market falls, the move happens quickly, or volatility stays elevated or increases. Because option CFDs track the premium of the real option, any combination of these forces can push the price of the put option CFD higher. Traders may choose to use a put option CFD to reflect a bearish view because there is no need to short the underlying asset, ability to benefit from falling markets and rising volatility, or simple execution. You buy the put option CFD and you're in the trade. Put option CFDs can provide traders with a clean, straightforward way to express a bearish view without the complexity of traditional options or the mechanics of shorting standard CFDs. Now, for the final piece of this presentation, I would just like to discuss some risk management essentials. Option CFDs use leverage, which means you can control a larger position with a smaller upfront deposit. This can allow traders to benefit in bigger moves, to participate in bigger moves without tying up large amounts of capital, while also amplifying their potential returns. However, leverage works both ways. It can also magnify losses, and that's why risk management shouldn't be optional. Remember, you are trading a CFD on the option price, not the option itself. Your risk comes from position size, leverage, time decay, and volatility. If we look at position size, this is a very important risk control when trading option CFDs. The option price can fall sharply even to zero, and your loss is based on exposure, not margin. Many beginners assume the initial margin is the most I can lose, like paying the premium on a traditional option. This is wrong. The initial margin is simply the amount required to open the trade. Your actual risk is the full price movement of the option CFD multiplied by the contract value. A practical rule to consider before entering this type of trade is to ask yourself, if this option went to zero today, could I absorb the loss? If the answer is low, then potentially the position may be too big. A simple framework for position sizing is to allocate 1 to 2% of your total trading account to any individual trade and then size your position back from that number. Next, let's discuss the use of stop losses. These are essential tools for the option CFD trader. Because you're trading the option price directly, the value of the option can change dramatically, especially when time decay accelerates near expiry or volatility drops. Some strategies to consider are percentage-based stop losses. For example, if the price drops X%, then exit the trade. Use support and resistance levels on an option CFD chart as you would with the standard CFD. In this scenario, as a rule, stop losses on long positions are placed below support levels, while stop losses on short positions are placed above resistance. Consider time-based exits. If the options price stagnates, decay is eaten into your position. This is especially common after earning announcements, after major economic releases, or when markets calm down after a volatility spike. So consider using time-based rules such as, if the price hasn't moved in X hours, then consider exiting the trade. If momentum dies, then maybe you need to close the trade early. And if the underlying is flat, don't hold and hope, exit the trade and reconsider your position. And then finally, think in terms of portfolios, not individual trades. Correlated positions equals concentrated risk. This is how traders accidentally create clustered risk without realizing it. Two trades can look different on the surface, but behave almost identically underneath. For example, being long a call on the S&P 500 and also long a call on the NASDAQ 100 over a US non-farm payrolls release. If one goes wrong, they both tend to go wrong together. To avoid this, consider capping exposure to a single trade idea, event, or market. If all of your trades rely on the same outcome, you're not diversified, you're leveraged on that one idea. Treat correlated trades as one position. For example, if you normally risk 2% per idea and you have 3 trades tied to the same theme, your total risk is 6%. That's how accounts blow up. Right, that brings me to the end of the presentation. Today, we've broken down the core building blocks of option CFDs, from the everyday meaning of calls and puts to how these products work on the Plus500 platform. And then we've also looked at the key forces that shape an options price. You've also seen why traders choose option CFDs and the essential risk management principles that help keep those decisions disciplined and sustainable. By stripping away the formulas and focusing on the concepts that matter, hopefully you now have a clearer foundation for exploring this part of the platform with confidence. And this is just the starting point. With these fundamental concepts in place, the aim is for you to be better equipped to take the next step, whether that's practicing on a demo account, diving deeper into strategy development, or expanding your understanding of how options behave in different market conditions. The goal isn't to master everything at once, but to build your knowledge layer by layer. Today's session hopefully gives you the groundwork to continue that journey with clarity and purpose. Right? There's lots of questions, so let's move on to answering some of them.